Let's talk markets ahead of the key tech earnings and economic data that we're going to hear from this week. Joining us, Gabriela Santos is the chief market strategist for the Americas at JPMorgan Asset Management. We got a lot of numbers, including jobs, of course, on Friday. What are you expecting to see this week, both on the earnings front and maybe some of the government numbers we're going to hear?
So we do get those job report numbers for April on Friday. We think nothing too dramatic happening. A little bit of a slowdown to about 130,000. There are a lot of unknowns around immigration as well as federal layoffs. But overall, it's still too early, we think, to tell the effect of some of these bigger policy changes we got in April. It seems more likely to us we'll have to wait until May, until June to see that data to be able to really calibrate our expectations. Similar for earnings. So far, it's been quite a good earnings season, but companies are feeling a little bit frozen as to the real clear guidance that they're giving us. And as a result, we haven't seen research analysts take down their earnings expectations very much for the year, basically in line with average. So it's also going to take us a little bit longer to understand. Sorry?
You think that's a mistake? That the analysts have not taken down the numbers?
Well, we think everyone knows they're not the right numbers. 10% is what we came into the year. It's still generally.
Can I stop you? Isn't that a problem? If everybody knows that they don't have the right numbers, isn't somebody not doing what they're supposed to be doing?
No, I think you get these during these big moments of uncertainty, during COVID, or even during the first trade war. It took us some time to actually understand how much revenues would be hit, margins, and then the bottom line. So what happens in the interim? The multiple does the heavy lifting. So you get that multiple contraction, and then
the market's already doing the work.
Exactly. And, you know, it depends exactly how much. But I think that's part of the reason why it seems unlikely that we unwind more than this half that we've already unwound of the biggest sell-off, exactly because we've yet to actually see the impact on earnings and on the economy. We all know the direction is softer. It's just a bit tough to actually calibrate that. And so the next 100 days are going to be really, really important to understand the base case for tariffs, the offsets from fiscal, the response from the monetary side, and what's going on with AI.
What is your sense? Look, there's a whole bunch of hedge fund guys and analysts that have paid enormous amounts of money to satellite providers to look at shipping coming from China, ships that apparently have nothing on them, ships that never went, all of this. And there's this view, I don't know if it's become the consensus view, that somehow we're going to get to the end of May and all of a sudden you're going to walk into all of these stores and they're just not going to have the merchandise you want. And all of a sudden, not only are they not going to have the merchandise, the replacement merchandise is going to cost more. Is that your expectation?
I think time is running out to see a lessening of the tariffs on China. And I think it's a little bit like it was in COVID in the sense that we're all looking and earning for some high frequency data to get that understanding ahead of the numbers, knowing that there's a lag. And I think it caught a lot of attention, and it should, over the weekend that we saw a 40% peak to trough drop in shipping from China to the U.S. because the tariffs are simply prohibitive. As Secretary Scott Bessent, Treasury Secretary, mentioned last week, everyone knows these 157% headline tariffs are unsustainable. But we really need to see them actually come down pretty quickly before we're not talking about higher prices and companies figuring out ways to pass that on. We're talking about actual disruption to the supply chain. And especially, remember, China has a pretty big control over a pretty important part of a lot of what we import from it. It's not easy to substitute overnight.
What is the wisdom inside of the House of Morgan, if you will, when it comes to the way Trump will ultimately deal with tariffs? Meaning some people believe that there really is a put and that he's just going to effectively not do all of these tariffs because he's going to realize that the market and the bond market and everybody else doesn't like it. And then if you read the Atlantic magazine yesterday, he says, I've had these views for 30 to 40 years and I'm going to do it. And this is what I'm doing. And if you don't understand that, you don't know what's going on.
Yeah. And I think it's all about the magnitude of the tariff. So it seems like we've gotten about 3 moderations in the overall headline level of tariffs overnight. News of an upcoming one on auto part imports. So that's taken down the headline tariff rate from the worst case, the highest since the 1900s, to the current, the highest since the 1940s. So I think there have been some moderation. We've taken some of the worst case off the table. That's good news. The market has recovered half of what it had sold off. However, our base case for the actual tariff rate we get was our worst case coming into the year, meaning still a pretty high tariff rate that remains, those 10% universal tariffs, as well as a halving of the China tariffs, which are unsustainable, but that still leaves us at about 60%. So that's why I think there's low conviction on the actual forecast for the economy and earnings. That doesn't mean there's nothing to do. So what we've been seeing our clients do is focus a lot more on rebuilding a core allocation. So much
what's in the core allocation, and does the Mag 7 have anything to do with it?
And this is really interesting because I think we're all coming into this big change in policy coming after a pretty exceptional 2 years, right? For equity performance, specifically growth in the U.S., specifically the Mag 7. So that was always going to normalize somewhat. We just got a catalyst from policy and from DeepSeek Monday. So what it means is a lot of our clients are thinking about more neutral allocation, equities, bonds. They're thinking about 50-50 value growth. They're really thinking about that international piece again. And within the bond side, it's rebuilding core fixed income because things had gotten either too cash-like or reaching for yield in things like private credit, leverage loans. So rebuilding the core for now before we get a bit more conviction one way or the other.